Good morning. It's Jeffrey Christian of CPM Group. It's just about 5 minutes before noon here on Tuesday, the 28th of January, 2025. I want to talk today about gold fundamentals and talk a little bit about what's likely to happen in terms of mine production, secondary supply, fabrication demand, official transactions, and investment demand over the course of 2025. But before I do that, I want to talk a little bit about this week's market activity, where the price is, and the relationship between investment demand and price, and what the relationship may be, relationship might be this year, as we are expecting increased investment demand and increased prices. So first, I used something like this last week in my Friday video. One of the things that we have is this week we have heightened political and economic uncertainties, both globally and within the United States. That's helping to stimulate some investment demand for gold and to a lesser extent for silver. We also have at the end of this week the first delivery date for the COMEx gold futures contract. Now, there's been a lot of congestion there. Last Friday, when I was talking to you, we had about 28 million ounces of open interest as of last Thursday in the COMEX February gold futures contract. Over the last 2 trading days, that has gone down to about 21.8 million ounces. Last Thursday, we had about 22 million ounces in the April contract. It's about 28 million ounces now. So you're seeing those companies that are short the February contract buying back those February contracts and rolling their short position into the April contract. So you're seeing that shift, and you'll continue to see that shift over the course of this week. That is one of the factors supporting gold prices. Gold prices are around $2,748 right now. They're up about $10, but they've been flopping around over the last several days, up $28, down $28, up $10. Silver is also doing that, but for silver, you have a similar situation in the March COMEX contract, which will become more of an issue over the course of February. Right now, it's less of an issue. Silver's trading about $30.57 right now as we speak. But we are seeing that roll, and we'll see how that roll continues. We expect that by the end of this week, on Friday, the 31st of January, will be the first delivery day for futures contracts. And at that point, we expect that the February open interest will be quite a bit lower than it was on Monday, when it was already down to 21.8 million ounces. The delivery process is very important to understand. Some people don't seem to understand this or be able to understand it. This is a futures market. It's not a physical market. So when someone is delivering into the February contract, they're delivering warehouse receipts for gold in a depository that's registered with the COMEX. A significant portion of the deliveries are taken delivery of on the long side and then immediately resold. I won't bore you with the details about basically looking to see what you can get in terms of delivery bars via the delivery process. Right? The delivery procedure starts with companies that are short the active contract. February is not active now, but it will be as of Friday. But the delivery process is that the shorts notify the clearinghouse, hey, I'm short February contracts. I have warehouse receipts. I'm going to deliver those warehouse receipts into my February contract. I'm dealing with the clearinghouse. The clearinghouse then on the next day those are issued delivery notices. The clearinghouse will then take those delivery notices and randomly deliver them to entities, investors or others, that are long the February contract. That they will stop the delivery process by actually delivering the warehouse receipts to the longs. The longs then have to either put up 100% of the value and buy the metal, or they can redeliver those receipts into the either the into a forward contract. So that's the delivery process. And the delivery process involves warehouse receipts. It can then, those warehouse receipts can be used to take delivery of the physical metal, which happens quite a bit, especially on active months like February. And oftentimes, the majority of the metal that's taken delivery of stays in the depositories. It doesn't move out. It might be deregistered and become eligible but not registered metal. More often than not, it stays registered because the groups that are taking those deliveries are active on the futures market, long and short. So that's the delivery process, and it starts on Friday with the shorts that want to delivering the warehouse receipts to the clearinghouse to be apportioned to the longs on Monday, February 3rd. That's what's going on this week. Now, I wanted to talk about 2025, and I mentioned this last week, and I'll mention it again. We expect record annual gold prices this year, and we expect higher daily prices this year. But we don't necessarily expect the daily prices to rise as sharply as they did last year. Last year, daily prices rose about 27% over the course of 2024, and were the best performing asset in our investment quilt of 25, or it's 11, it's 9 asset classes plus gold and silver. The annual average price did not rise quite that sharply, but it rose sharply. I'll get back to that in a second. And then I'll talk about the fundamentals. So let's look at these. And the key, there are several keys. First off, you have to understand gold prices have already doubled since the beginning of 2019. Gold prices were trading around $1,284 on the first trading day of 2019. They're $2,784 now. So they have risen 113% over the last several years. So when people talk about how I expect gold prices to rise sharply, to some extent, they already have. Something to pay attention to when you hear people talking about a 10-fold or a 50-fold increase in gold prices likely this year or next week or whenever. The little rational expectations suggest, hey, we're already up more than double over the last 5 years. And those 5 years have been pretty interesting years economically and politically and socially. We've seen the lockdown, the recovery from the lockdown. We've seen a spat of inflation, which went from 3% to 9% and is back down to about 3%. We've seen all kinds of political chaos. We've seen a deterioration in social order around the world, not just in the United States, but in many other countries. We have a lot of economic and political and social issues that have been in the fore. And in that environment, we saw prices rise sharply starting in the second half of 2019 into the middle of 2020. Then we saw the prices consolidate those gains between 1,640 on the low end and 2,040 on the high end over 2.5 years. And then we saw, starting in late 2023, prices rising again based on investment unease due to political and economic developments. We started 2024 around $2,300 an ounce. We started 2025 at $2,660 an ounce. So we're starting from a much higher base. That means that you could see 12, 13% increase in gold prices on an annual average basis purely due to the fact that we're starting at a higher base. Even if on a daily basis, the gold price trades between, say, 2,500 on the low end and $3,000 on the high end. So you're seeing that kind of mechanism there. You could see higher and record daily prices, but maybe not as forcefully rising as they did in 2024. And you could see a sharp increase in the annual price to a new record price, even as investors buy a lot of gold. Investment demand, in fact, may rise sharply. Our estimates were that investment demand in 2021, 2022, 2023 were around 25, 26, 24 million ounces per year on a net basis. Obviously, some investors are always selling, some investors are always buying. Those are the gross purchases and sales. On a net basis, on a global basis, physical demand or demand from investors were 24 to 26 million ounces in that 3-year period, post-COVID, prior to 2024. Our initial estimates are that investment demand on a net basis was around 31, 32 million ounces last year. And our expectation is that it could get up to 42, 44 million ounces this year, which, as you can see from this bar chart, would be one of the 4 highest levels of investment demand, should it happen. Now, you see investment demand rise 50% last year, and then you see another 15, 30% increase this year, and you say, well, if investment demand is going to rise that high, maybe prices should rise sharply again on an intra-year basis. But again, you're starting at an already very high record level for prices. So investment demand may rise sharply this year, even as daily gold prices rise less forcefully than they did last year. Prices may stay high, in other words, move somewhat higher, reach new intraday records, and reach a new annual record price. And investors may buy more gold on a net basis in that $2,500 to $3,000 range than they would if the price rose even more sharply. The price rose to $4,000, you might see profit-taking sales by some investors, and you might see a reduced fresh demand because the price was so high. You also have to take into context what might be happening economically and politically to cause investors to surge into the market and drive the price higher. Our expectation continues to be that we're likely to see a recession, possibly starting in the last half of 2025 and extending into 2026. Our expectation is that such a recession could be difficult. We're working through the economic outlook, but a lot of the factors that we're looking at, increased trade wars, less cooperation and international trade among nations, tariffs, increased deficit spending, increased debt, higher interest rates, tax cuts that would be both inflationary and recessionary, increased difficulties for 90+% of the populations in the United States and other countries to meet their basic needs. All of those factors could put a brake on investment demand and investors' willingness to spend more than $3,000 an ounce for gold. So we do expect record highs on an annual basis and on an intraday basis. But we're being cautious, even in an environment where we think the economic and political environment will be hostile, and investors may buy near record amounts of gold on a net basis. That's our outlook for gold investment demand and prices this year. Central banks We saw them pull back to about 8 million ounces last year. This is not quite updated. Through November, we've seen about 8 million ounces net. We don't have December data yet. Should come out within the next few weeks. Um, and we'll see where that is, but it's probably 8 to 10 million ounces. As I explained early last week, the higher gold prices have put a brake on some central banks buying. The stronger U.S. dollar has distracted some central banks from buying gold. And there's been a big focus among central banks on domestic economic conditions, which have been relatively hostile in most countries. They are a mixed bag in the United States, uh, but we've seen central banks have to pay attention to their economic situation rather than reallocation of metal. Central banks are not really de-dollarizing. That's a hokum that's been spawned by gold promoters, and it doesn't hold up to statistical scrutiny or anecdotal information or what the central banks are saying themselves. The BRICS nations have said they're not into de-dollarization. They're into a long-term modification of central bank currency holdings. That's exactly what most central banks have been saying since I got into business in the late 1970s. So nothing really new there. Maybe a little bit more urgent on the part of pariah states like Russia, but c'est la vie. Central banks may buy a little bit less gold in 2025. If it's 8 million ounces or 9 million ounces this year, it might be 7 million ounces next year or this year, down from 8 or 9 million ounces last year. They continue to buy gold. This gives you this broader view. You can see from 1950 into 1964, central banks were adding gold. That's because they were using gold for international trade and capital flow settlements. And so they were accumulating gold. That started to end in 1967, 1968. You saw a large run on central bank gold held by the U.S. Treasury. Central banks were basically saying, if you think that gold is worth $35 an ounce, or rather that the dollar is worth $35 an ounce, here are my dollars, give me your gold. There was a big run on the central treasury holdings in 67 into the first 4 months of 68, at which point President Johnson closed the private sector gold window. President Nixon closed the public sector gold window in August of 71. And we entered a period of demonetization in the 70s and early 80s. Then you saw this period of time really starting around 1977, but culminating around 2007, where a lot of central banks, major central banks that had accumulated gold in the 50s, were saying, hey, I've got 80, 90, 95, 97% of my monetary reserves in gold, which is not particularly useful. I really need dollars to defend my currencies. So those central banks sold some of their gold. In some cases, the central banks sold half of their gold. A couple cases, they sold virtually all of their gold. In other central banks, they sold less than half, or maybe 10% or 20%. It depended. It varied from bank to bank. By 2007, those central banks that wanted to sell some of their gold had sold most of the gold they wanted to sell. And we saw gross sales by central banks fall sharply in the period 2005 to 2008. Other central banks that had not accumulated gold in the 50s and early 60s, but had accumulated dollars during their economic growth spurts in the 70s, 80s, and 90s and aughties, said, gee, I've got a lot of my wealth in gold, in dollars. I want to diversify my portfolio. And they started buying other currencies, and pound sterling, Swiss franc, yen, Japanese yen, other currencies that were emerging, to some extent initially the euro, but that has actually declined over the last 2 decades, and gold. And so we've seen central banks as net purchasers since around 2008, on average about 10 million ounces a year, varying with the price and economic conditions in individual countries. Mine total supply we have projected to rise this year and to rise somewhat healthily. If you look at it though, most of the increase will be in secondary recovery from scrap. You are seeing some increase in mine production. It's slow and steady, and it continues to be slow and steady. It may accelerate a little bit this year, but I think we're talking about 1 or 2% increase in mine production. Secondary recovery is rising more forcefully, partly because of the price, partly because regulations requiring um, end-of-life electronic and other equipment being recycled, and partly because of economic conditions. A lot of gold is held in jewelry form and decorative form by people who use it as quasi money or outright money. And when economic conditions are tough for them, they may sell more gold. With a high price, a record high price, and stringent economic conditions could lead to a further increase to record levels for secondary recovery this year. Um, and then there's fabrication demand. Fabrication demand is negatively correlated with the price. When the price rises, there are two levels of demand for gold for fabrication demand into jewelry and decorative objects. The first one is at the fabricator level. Fabricators of jewelry try to maintain price points for their jewelry. They know what kind of prices people are willing to buy the vast majority of gold jewelry. And when the gold price rises, they will use less gold per piece in order to maintain that price point at which they think investors or consumers will buy the majority of the more gold jewelry. So there's a price sensitivity at the fabricator level, and then there's a price sensitivity at the consumer level, both because of the price of the jewelry and the price of the gold content in that jewelry. So as the gold price rises, you'll tend to see gold jewelry demand fall. And as the gold price falls or is flat, you'll see jewelry demand rise. That is most dramatic from the big decrease you saw from 1978 to 1980 in jewelry demand, because the price went from $200 to $850 on an intraday basis. And then the big increase in jewelry demand from 1980 into about 2001, which was partly inspired by the fact that gold prices were flat to lower over that 20-year period. You also saw other factors. You saw increased economic disposable income in many parts of the world. You saw economic deregulation. You saw increased international trade, increased economic growth in many parts of the world, most parts of the world during that period of time. So people had more money to spend on jewelry, and the jewelry was more affordable. The third and fourth factors that really drive jewelry demand are fashion and marketing. If you spend money marketing gold jewelry, you'll sell more gold jewelry. It sounds obvious, but you'd be surprised how many people in the gold industry don't necessarily catch on to that. So we saw jewelry demand rise sharply into 2001. When the gold price started rising again, and economic conditions became more stringent, you saw jewelry demand fall. And that's probably going to be the case this year. High prices for gold and gold jewelry and recession. And we're not seeing as much marketing into gold jewelry, and we're not seeing as much fashion. There is some of that going on. I've been surprised the last couple of weeks, but we are moving into the Lunar New Year tomorrow, and we are moving into Valentine's Day in the Occidental countries. So you're seeing some of that. But what you're really seeing a lot more of is people turning to chunkier silver jewelry because it's more affordable than gold jewelry at this point. That's all I have for gold right now. Pretty much the same is true for silver. We will be coming out with our gold yearbook March 25th. You can go to our website and pre-order it. Our silver yearbook will come out in late May, and platinum group metals yearbook will come out in late July. We will be doing our Silver Facts and Fantasies online seminar on Thursday, the 27th of February, uh, the week before the PDAC silver reception in Toronto. You may go to our website, pre-order books, buy other research that we have, send us an email at info@cpmgroup.com if you want to talk about other ways that we can help you either with research or consulting services. That's all I have for today. Take care of yourself. Take care of those around you. Do something good for the world. Stay calm, and we'll talk to you at the end of this week.